Welcome everybody here to our next webinar at JFD Brokers. My name is Stefan Friedrichowski, as always, for those kind of webinars. A warm welcome in the name of JFD as well today for the topic Vola Breakout Strategy with Martingale Elements. Well, you see, the title is extremely long because I have to bring in several topics here. And yeah, the title is really a little bit like the program because we have a lot of elements mentioned here in the title. And all of those have to do, with the strategy we want to develop, we want to introduce here today. Today, we have the 21st of November 2018, 7 p.m. So, standard time, so to say. And maybe one additional remark, because I know we have the English one here today, but there is World of Trading in Germany starting on 2 days on Friday in Frankfurt. And if you have a chance to come there, then you might have a chance to come in touch with me personally, because I will be there the complete 2 days. It would be really a pleasure for me to see you personally. So anyhow, it's an opportunity, but I know normally we have here the international ones, so Frankfurt will be not that close as for many other people within Germany. Back to that complicated title, Vola Breakout Strategy with Martingale Elements. You see, there are things mentioned. Vola means normally volatility. So in this case, it will be once again, as maybe always when I talk about volatility, I go for an ATR, an average true range indicator. So that is one element. Breakout strategies, that is really something we know for sure. We know very well. But normally those strategies work with time periods. Like, let's look between 8 and 10. Let's see what price range do we have within that time range or time period. And then we organize our breakout trades. So it will be a combination of both volatility and breakout. And finally, I mentioned Martingale Elements. So you might be familiar with Martingale Elements or Martingale trading strategies. Standard-wise, or in most cases, that has to do with doubling your amount of money invested or doubling position size of your trades or anything doubled. But let's see how we can use it. There's a reason why I mentioned Martingale Elements and not purely or Martingale. Anyhow, you see already my contact here. You might already download the slides for today directly via the GoToWebinar control panel. You have my email address if you have interest in any Excel sheets or anything else which is shown here during the webinar. No problem, just send me an email and I'll make sure that you will get it soon. Before we start, really, I have, as always, to show that one here, that slide, our risk disclaimer, mentioning that finally, whatever you do, you do it by your own responsibility. But I think that's self-explaining, although we give recommendations here about what I would like to do, what I do indeed. But anyhow, it's always your decision and your own responsibility. Okay, but let's look a little bit more in detail. So we have definitely to have a short recap about Martingale. We have had already one a webinar about Martingale trading strategies. Therefore, just a short recap, what kind of elements we use there and what is the origin and how we use it. Then we go in depth into the strategy of Vola Breakout and what indicators we use, what kind of elements, what kind of calculations we do, and so on and so forth. So all the details about that strategy. we have to talk about position size in detail because we will do something special if we have a losing trade. How to do and what to do, um, we have to calculate and we have to discuss. I will show a couple of examples of strategies for different underlyings, but overall I will show what kind of underlyings really work well with that kind of strategy. And finally, as always, I build up a portfolio of those, and that is done including the walk forward methodology for trading strategy development. Um, a few of you might know what I mean with walk forward. Is has always to do with optimization within the past, then apply those rules in the future of that past, and then iterate those steps until today, so that we really do not a pure back test like most people do. So it's a little bit different. It's it involves a lot of computation time, but it works quite well and gives you more confidence about the real future if you start that kind of trading strategy tomorrow onwards live. So let's start with Martingale. So what is the origin of Martingale? Well, Martingale stems from the roulette table. And normally if I even simplify a roulette table to a red and black and forget all the numbers and forget the green zero, it makes the life easier here for any calculation. So now, then we have only red and black. And normally what you do is you put a coin on one of those red or black fields, uh, and then either you lose or you win. In case you win, you get the same money additionally back. So, for example, if you put €1 on the table, then you will get the one from your own and an additional euro from the bank. If you lose, okay, money gone. So then you lose exactly that €1. But what you can do is you can do a simple rule. If you lose, you double what you put on the table. And that's all. You double your pool. And that means after you put your money on red and black comes, then you have lost the €1. Then you double your pool and you put then next step €2, for example, once again on red. And maybe you lose or you win. But that's everything. In case you finally win, you go back to your original pool. That's all. And that's exactly Martingale. And there's a nice anecdote about that Casanova has been a gambler of exactly this approach. Let's have a look at what that kind of approach means for your equity, because we are trader, we like equities, and therefore it's good to have that on view directly, and we can calculate it quite simple. In this case, what I do here is really just pure statistics. So in this case, my pool is €5, my initial pool, and then I have random numbers, and in case the number is above 0.5, I will lose. And that's exactly what's shown here if we go through that kind of sequence. In the first run, then I lose my money. So €5 gone. So I have started with €200 and I'm back to 195. What I do is, as explained earlier, I double my pool and unfortunately, once again, I lose. So going back additional 10 euros. Doubling the pool means now €20, but bad thing is once again I lose. So I lost already in total €35. Doubling the pool means now €40 already, but now I win. And that means I'm back in the race here and back at €205. And you see what kind of equity we get. Looks nice, looks like more or less a straight line going up, which is of course nice, but there's a but. Let me reassemble the numbers. Let me just get new random numbers. That equity even looks better. What I'm really doing is I press F9 in Excel, and now I have an equity. Oh, it's already getting dangerous, because what you see, what happens if you do those kind of martingale steps, you are doubling, doubling, doubling. Yeah, and that results in maybe already close to 400 euros a pool. So it's a big number. And let me press F9 once again and see. Oh yeah, there happens one thing which is typical here. You see, I'm going back below minus 1000. Okay, in Excel, I can show you exactly that, but in the real life, that would mean I'm bankrupt. That's all. So I have no money at all. So after about 8 rounds here, I'm gone because no money left. That's exactly what happens if you go purely martingale. In principle, you always win on a long run, but there are two restrictions. You need unlimited resources in terms of money. Not quite easy. Second, there, if there's a limitation at the roulette table, which is normally in place, then it doesn't work. And normally there's a maximum number your pool can be, and but you need that doubling process here. So therefore, strategy in this case doesn't work for a long run. Short term, maybe yes. But even on short term, in this case, looking for exactly that equity here, already after 8 rounds, we are bankrupt. But of course, there might be other ones doing better. Look for this one here. And after 100 rounds, we are at 450 euros, so we gained 250. Anyhow, that's the concept of martingale, and we have to tame that concept. And we need exactly to do and know what we do. We need limitations in terms of how far we go, and maybe just that doubling is not the best thing to do. But we will see. There are better things we can go for. And let's really start with our strategy. I know that slide is terrible. It has minimum 10 lines, written lines. So let's go through line by line, but then I will show you the same visually in a graph. So in the standard chart of MT4, because that are the rules for the Vola breakout strategy, at least for the starting. It looks terrible, I know, but it's really easy. We start with what I call a reference time. That might be, for example, 10 o'clock. And that point in time is our starting point. So what we do there are two things. First is we will measure an ATR value. So we need an ATR. Special period. What I go for is I go for 1 week, and I use an M5 chart. So to have then a 1 week history within my ATR indicator means I need a period of 1,440, because that's exactly 1 week of M4 candles. So we measure our ATR value. And the reason is we want to know what is the volatility, more or less short term, and even 1 week I call now short term. But at least I want to know whether we are in a market environment like, let's say, today, or in those heavy conditions like financial crisis. At that point in time, the DAX, for example, made 100 points in 5 minutes. Today, it might need 1 day. So volatility can be totally different, and I want to take that into account for that strategy. Therefore, we measure the volatility in terms of an ATR value, and then we place our first orders exactly at our reference time. How to place those orders? Therefore, we need First parameter, reference time. Second parameter, we need a multiplier for that ATR value. And that is a distance where to place those orders. And we will place 2 orders. Since the strategy has a breakout within its name, therefore we place a buy stop order at close price at the reference time plus multiplier times ATR value, and the sell stop order exactly on the other side. So that's quite simple. It's a standard breakout procedure. Stop loss for those orders is always the opposite side, so quite easy. Position size we need for any trade. Therefore, we have to decide on our initial trade risk. In my case, it will be 50 euros. So the position size is then more or less automatically calculated because we know the entry and the stop loss, and those 2 numbers, and our risk per trade calculates the position size. Since we need to take profit, let's go for a risk-reward ratio. For example, if that would be 1, it would be exactly double twice of multi ATR times ATR value, because we normally go 1 step to the north and 1 step to the south, and so that will be our total distance for setting the stop loss. And let's go for a risk-reward ratio, and that measures our take profit level, so that kind of distance. In terms of degrees of freedom, we have 3 degrees of freedom: reference times, multiplier on the ATR period, and our risk-reward ratio. In principle, I could say the ATR period is the 4th degree of freedom, but I use a fixed one for 1 week in M5 chart, as mentioned. That would be a period of 1,440. So finally, I have 3 parameters, which is fair enough. It's not a huge number, but that's okay. I know. So that has been a long explanation of how to use or how to set up this strategy. Let's do it visually within a chart, because that makes it a little bit easier. Let's start with the DAX chart, and that I prepared already a DAX chart here. Just an easy chart, M5 period, and so we start with the reference time. Let's set that reference time to, for example, 8 o'clock. And what does it mean within a JFD chart? At 8 o'clock, it would be 9 o'clock German time. So why not go for that? So here we have that reference time. Then we need the close just before that reference time. That would be this level here. So let's have a horizontal line here as well. And let's mark that line once again in blue and a little bit thicker. So here is our reference time, the vertical, and the reference price, which is the horizontal line. Okay, now we need an ATR. ATR, no problem, that we have within our standard indicator set here. And let's go for minimum fixed, and we need a period of 1,440, because that is just 1 week. And now we see that indicator here, or the value, is about 13. And let's calculate everything just with 13. That's fair enough. So our reference price here is, let's go for an integer number. So let's go for this one here. That is 11,144. And now, okay, we know the ATR is 13 points. We need a multiplier on that. Let's say 2. So 2 times ATR would mean 26. So that finally means we have buy stop order, let me first change the color here so that we see that a little bit better. So let's go for red in this case, or that's okay. And that should be at 26 points above the reference price. So it means 50, 70. Okay, here we go. That would be our buy stop level. And of course, we need a sell stop as well. So we have two orders in place. One here, and the other one would be here, 26 points below. And that's the starting situation. And those levels, we will keep those levels. Let's go through the chart and see what happens. So I'm not 100% sure what it means, this one, whether it hits our order level, yes or no. Finally, here definitely our buy stop would have been triggered. Okay, if that is the case, then we would need definitely a take profit for that. Let's assume we go for risk reward ratio 1. Then the overall distance between entry and stop loss is 52 points, and we would do exactly that kind of distance, which is about here. So I do not do it here maybe correctly mathematically, but it's about that. There we have that point, and let's put that in green. So that would be our take profit level for our trade. And now let's go through the chart. So our order would be triggered here, and then unfortunately price goes back, and definitely it would have hit our stop loss. So here, at that point in time, we would be kicked out of the trade. And now let's go for the other rules of that game, for that kind of strategy. Let's go for Excel first, because I wrote those rules already down. So we have our first trade, and if our first trade reaches take profit, no new trade, done deal. In our case, in the graph, in the chart, not this time. So if it would be done deal, day end, we have nothing to do until the end of the day. Unfortunately, we hit our stop loss. If we hit the stop loss level, we instantaneously open a new trade, but into the opposite direction. And now the critical part comes. What position size? And the position size of the second and maybe third and maybe fourth trade depends strongly on the risk-reward ratio. The principal idea is that finally, if our last trade hits take profit, we want to totally gain. Our total profit should be like for the original first one. So in this case, exactly our risk-reward ratio, but including all the losers in between. So if it would be the fourth trade, then we need to get back all the lost money for the other trades. In order to do so, and if you do the math behind, then you will realize it's quite easy. It's the simple equation 1 plus 1 divided by risk-reward ratio. In my case, with a risk-reward ratio of exactly 1, it's exactly that doubling. Because if I put it down into the equation here, then I have 1 plus 1 divided by 1, which is 2. And that is my multiplier for my risk. So if I start with, for example, risk 50 euros, and I go for my second trade, then I have to double my risk. So that would be exactly the original Martingale situation. And you see already the trick. If you go for risk-reward ratios bigger than 1, then we don't have that kind of doubling anymore. So it would be less than doubling. Before we go back to the chart, let's have a closer look to that within Excel, because it's really nice that we can use that kind of, let's call it, no, it's not a trick, it's just mathematics, it's nothing more, but it helps us a lot. So I have created just a table here, how the position size would develop over number of trade. And let's go first for the pure Martingale situation with the risk reward ratio of 1. And then you see exactly what we do is the kind of doubling 1, 2, 4, 8, 16, and so on. If we do that 21 times, we are already at 1 million. So I think nobody could afford that risk anymore, but at least not for any private retail client here. So we get really huge numbers. But now let's apply that rule of 1 plus 1 divided by risk reward ratio. Let's go for risk reward ratio of 2. Then you see it's not anymore a times 1 million. Now it's 3,000. And if, for example, we have risk reward ratios of 5, then we are in a level here, okay, it's still a factor of 38 after 21 rounds, but it's more or less affordable. At least we can do it. So that's not really a trick in terms of, let's overcome any other things. No, it's pure mathematics, nothing else. Still, we have to keep in mind a risk reward ratio of 5 means we need 5 times the distance of our stop loss distance until we get there. In case of our chart, when we have a stop loss of 52 points, risk reward ratio of 5 means 260 points. Okay, that's already a distance. So the higher risk reward ratio will be, the harder it will be to go there. On the other hand, what we can do else is we can go for smaller multipliers for the ATR value. That makes our range smaller, and then maybe now we get a deal. You see how it works. But that is really important to keep in mind what we are really doing here. So risk reward ratios above 1 will help us to get a lower overall risk in terms of the doubling procedure. Let's go back to the chart because now we can go for our trades. Remember, we started with a long trade. That long trade went into stop loss. So since we have a risk reward ratio of 1, it means we have to double our lot size. So we go for a short trade here, and you see what happens. A couple of candles later, we are in stop loss once again. And now we have to double once again. But you see what finally happens. A couple of candles later, we go for take profit. And doing the position size, as I mentioned, means now we have recovered all the loser trades before, and finally we have exactly the profit of risk reward ratio 1 for the initial risk. So doing the math would mean our risk has been 50 euro. Our profit is now exactly 50 euro, finally, including the money we lost for all the loser trades before. And that's the logic. And now you can see already what's good or bad about that kind of strategy. A day like today would be a wonderful day. Even if we would have 2 losers, the third one would have recovered everything. So we are fine. let's look for what is a real bad day. So a real bad day would be a day looking for those lines. If we have something like a synodal behavior, just always going a little bit above or below those red lines. That would be a real nightmare because all the time. So the day started like that nightmare day. So we went up a little bit above the one red line, a little bit below the other red line, and once again a little bit above the next red line. Fortunately, price went up further. So everything is settled, everything is fine. But the nightmare day is a day when that kind of behavior would continue. Okay, let's keep that in mind. What's good for this strategy? Good is if we have finally one move far enough hitting our stop, our take profit. If we have some wiggling around before, it doesn't matter. We get finally our profit. So nightmare day is if that wiggling goes on, goes on, goes on. Then we have that kind of nightmare day because remember we are always increasing our position size. All the losses will be the next loss will be bigger than the previous one and so on. So it might add up to some real amount of money. So we have to take that into consideration and we finally draw our conclusions. But that is how it works. But let's see that kind of trading idea, trading strategy in practice. Unfortunately, I cannot show it to you in Excel because it's a little bit too complicated. We need small time frames for that kind of strategy in order to investigate, in order to calculate complete time periods. Because if I go for example, for H1 data, I get in trouble because I simply don't know what happens first with those kind of candidates. So we need small time frames. That means we need thousands and even millions of data points. So Excel is not well suited for that. But I can show you to you with my C programs, and let me give you an example. Let me start a calculation. It will always take only a couple of seconds here. Let me start a calculation for euro US dollar, and I go for a special set of parameters, and those are written in those numbers here in the right lower end corner. And you see the 1440, that's the ATR period. Then the next number is 3, is a multiplier on the ATR. Then the 1.0 is the risk reward ratio. We start with that. And the 600 is 10 o'clock because I always go for minutes after midnight. And those 600 minutes after midnight translate exactly to 10 o'clock. So 600 divided by 60 is 10, and therefore that is 10 o'clock. Okay. Let's do the calculation because now the strategy runs reading the data, the M5 data, which is 1 million data points for 14 years history, and calculation is done. Even the visualization, complicated word, visualization, I didn't get it. Anyhow, here's a graph. And that is the equity. And what can we conclude? Funny enough, during the financial crisis, strategy didn't work, didn't lose that much money. But after that, we have a good hit here. So that works well. So that's how the strategy is. In this case, let me at least once show you a little bit more how really the traits are created out of that strategy, or how it really looks like, because we can learn a little bit about the internal of the strategy here as well. So what you see here within the Excel sheet is a complete list of traits for that set of parameters, and starting in 2004. And you see what happens. First trait, first line here, risk 50 euro, as mentioned. and it was a loser trade. And finally, we get a loss of 46 euro. The reason it's not exactly 50 is I always do the integer rounding, because I can only place orders like 0.01 lot, 0.02 lot, and so on, and therefore I do the calculation here correct, and therefore my risk of 50 euro finally means I lost 46 euros. That was the first trade, and the same day we turn our trading direction. We have a second trade with double risk, because risk reward ratio is 1, which means doubling in case of losses. And once again, it's a loser. And then the day is over. What I mentioned, not that strict until now, is I have a fixed time stop. And you saw that already on my slide. Let me quickly go there, because I use a time stop. And that time stop is meant for several reasons, or I use it for several reasons. One is I don't want to have overnight trades. Okay, for Forex, it would be fair enough. Beside weekend, then latest I should close my trades, because otherwise I have the gap risk of a weekend. But I want to avoid swap costs, and I know that a little bit later than a quarter past 10 p.m. we get that spread increase, spread widening, and therefore I close the trades quarter past 10 all the time. And I even realize my losses, in case there are one, then better to stop it than to go further. Finally, I would have a real problem if I would go over the night until the next reference time and I would still have a trade open. What to do now? Anyhow, I don't get that kind of question. So I stopped trading at quarter past 10 with a time stop. And that's exactly what happened within the Excel sheet or within that set of parameters and that kind of sequence. Next day, more or less the same happened. We open a trade, but finally we go for the time stop, and anyhow, day is over. Then the next day we have a winner day with 50 euro. Everything worked well, and so on and so forth. You see, that's how it works, and that's running perfectly. Let's go for a day like this one here. That's a big losing day because we go 2 times doubling with a loser. And in this case here, we have finally a winner. So that's how strategy works. I mentioned already that going for a risk-reward ratio at 1 is maybe not the best idea. So let's see directly what happens if we go for other risk-reward ratios. Let's go, for example, a risk-reward ratio of 2 instead of 1. And have a look to the equity, which will be there in a second, because calculations with those kind of C programs are really fast. And you see equity is getting a little bit more straight, which is fine. And if I go for, let's go for 5, risk reward ratio of 5, we can flatten our equity even a little bit further. And you see, it's working better and better. And it's not really a big step of optimization what I do here. It's just going for a risk reward ratio of 1, 2, and 5. Okay, I set already the values for reference time at 10 o'clock and the multiplier for the ATR period, the ATR value to 3, but it doesn't work that bad. So strategy is doing a real good job with those kind of parameters. And let me exactly tell you how I do it finally with all my sub-strategies for different underlyings. So I have a couple of risk limitations for that kind of strategy. And those kind of risk limitations are in total three. So one is that I have a maximum risk. Because what I do here is, in case I have a loser trade and I have to increase my position size or my risk value, I will stop that procedure finally if I have 10 times my initial risk. In my case, it would be 500 euros. So I have a absolute limit for my risk. It's 10 times initial risk. I don't go for any further increase. That prevents me to have the big losers in case everything is, or a day would be more or less what we meant, or what we described a little bit like a nightmare day. So we have a maximum risk. Then I have a preference here to go for risk reward ratios bigger than 1. That doesn't change the overall risk behavior, but with risk reward ratios bigger than 1, I can go for more loser sequences. So in case of I have to increase my risk, I can do more steps like that. That's a good thing as well. And finally, I have that time stop at the end of the day. So everything stops. Whatever happens, there's a stop. And that's always good, that we don't have any unlimited risk, like when I introduced the Martingale concept. That you see a little bit what that means. Let me go for some other parameters here. Let me show you a set which shows directly that we have to do here with real devil stuff like Martingale. Let me go for a risk reward ratio of 0.7, and let me decrease my multiplier to 0.7 as well. And let's have a calculation of the equity and go for 9 o'clock now as an entry, as a reference time. And that's how the equity now looks like. Okay, that's amazing. On the one hand, you may like that kind of equity because the increase is huge. So in total, profit is 200,000 euros, more or less straight line going north. So perfect. But you see the but. What I showed here is a real equity, including the intermediate losing trades during a day. And at least we have 1, 2, 3, 4, 5 days which have been a real nightmare. Okay, I know, within 14 years, but we have those days. And if we would go for exactly that kind of strategy, I know for sure in the future we will have those days as well. And now the question is, can you survive a 100,000 drawdown? And maybe the answer is no. So the problem with that kind of parameters, with that kind of set of parameters, there might be floating or intraday losses, which are extremely huge. And you see what I mean with huge. That day here would have been a loss of 250,000 euros. Okay, it recovered. Nice. But you see what happens finally. So that is the drawback of real Martingale without any limits, without limitations. If I go for those kind of limitations, as I mentioned, which are not applied in that single program here, but in the walk forward, we have all those other limitations. Then we have a little bit different situation, and let's have a look to that as well. Since it really worked well. But we know, or we have to know, what we are really doing. So if you go for the good underlyings, and those are underlyings which have a real tendency for trends, like Australian dollar, US dollar, euro, Japanese yen, euro, US dollar, Canadian dollar, and gold. And even DAX, which I started to investigate just yesterday. So my portfolio is without the DAX. Even the DAX is really good. So I will show you in a minute. So that's how a final equity looks like. And then even applying that walk forward methodology, meaning not a single back test as those violet equity curves shown a couple of minutes ago. That is now really walk forward methodology, and still it really works well. We don't have those spikes to the south because of heavy martingale elements. We use here risk reward ratios far above 1, sometimes even up close to 10. And then it looks like this. And since let's have a look to those parameters and how those parameters, our 3 ones, reference time, multiplier, and risk reward ratio, how those may change over time during applying the walk forward methodology. Let's go directly for the best one here. That is the US dollar, Canadian dollar. And I can show you how those parameters develop versus time. So let's have a quick sort here, and then we can go directly further. Oh, sorry, there was a mistake. I go once again. Now it works. Sorting. And now we can have a look to the parameters. Let's, for example, start with the reference time. And the reference time looks like this over the last 14 years. And you see more or less all the time it has been between 700 and 800. That means 720 is 12 o'clock. So it's about 12 o'clock here. That's that line. Only a couple of weeks ago, there has been earlier entries or earlier reference times, but it's quite stable instead of those 3 periods here. So you see the parameters doesn't change that much. So that's reference time. So it's a quite handy time, like 12 o'clock. So why not? That's good. Let's go for, or let's have a look to the risk reward ratio and how that develops over time. And then we have a little bit more changes within the period of 14 years. But you see, there's a tendency to higher numbers. Only a few times we have values close to 1. Most of the time we have risk reward ratios of about 6. And finally, let's have a look to the multiplier, the multiplier for the ATR value, and let's see how that develops. And there we have more or less 2 states. One is a low multiplier of about 0.2 or 0.3, and another one which is about 3. So a small one means we might have a couple of trades in a short sequence, and then finally we have the one which gets all the profits. And sometimes we do exactly the opposite with higher values for that ATR multiplier. So that's how the numbers develop over time. And finally, let's have a look to the DAX, because that is maybe one underlying, which is not part of the portfolio, but maybe we can get a good strategy for that as well. So let's see how it is the equity over time versus time. And that doesn't look that bad. So it's 80,000 profits. Okay. The downside is during the last couple of weeks or even months, we have a flat behavior, but flat does mean not losing money, but also not gaining money. But it looks really good. So DAX should be included into the portfolio, and parameters we know. So that's how it is. Let's go back to how to interpret all those trading ideas here. What we know for that kind of strategy is that we need at least once a day one move into one direction. Later the day, earlier the day, doesn't matter. We need that one move. But now let's ask a question. Maybe we can amend that strategy to some special situations which are ideal for that kind of strategy. So we need at least one move during a day. Does it ring a bell? What about if we go exactly for those days with, for example, central banks' decisions like EZB or Fed, or well, we can go for other currencies as well. So whenever we have a central bank decision, normally we get moves. We don't know the direction, but at least at the end of the day, there should be one move in one direction. And since we don't know initially which direction, that kind of strategy would recover potential losses before. Downside might be we know that exactly on those days we have spread widening, we have slippage within those trades. So we have to really check that live. But it's worth an idea to go exactly for those days which are known for moves. Think about every second Friday with the non-farmers payroll data in United States. Normally we have moves. We don't know the direction, but the strategy helps us to recover potential losses before. So those days are ideal. So I think it's worth to spend another webinar on that kind of strategy here and just focus on those days. So it's more than a strategy for exactly the moving days. Nevertheless, already now strategy really works good, really well. And you see the kind of equity we can achieve here. But I think we can even do better if we just focus on those special days which are known for moves. And we know those days in advance. It's a good thing. So finally, we have a quite simple approach here, and we see good and promising results for trend following underlyings, like mentioned. The strategy itself is just based on one ATR and a given reference time. And what we need are yes, the ATR value, the ATR multiplier, and finally our risk-reward ratio. We have to tame that strategy because in case of losers, we increase our risk. So that has to be done well controlled. Therefore, I call it just taming martingale approaches. Risk-reward ratios bigger than one helps us. We have an overall risk limitation in terms of value. And finally, we stop all trading activities at a certain point in time before midnight. All those risk limitations are, let's call it them, vital. Otherwise, we might lose too much money. But with that kind of overall approach, we have a good next strategy for our strategy portfolio. And we know already a little bit more how to maybe improve it or just play that strategy at certain days. And those days we will investigate will be those with central bank decisions. That will be our next step and our next webinar. Okay, that's for now. I hope you enjoyed the webinar today, and see you again next month, and maybe see you already on the World of Trading in Frankfurt this weekend. Okay, thanks. Bye-bye.